Hi, everybody. This is Travis Rogers. Most of you know, worked with hundreds of companies, startup companies in the dental industry. But what I'm going to talk about today actually applies to any startup company, or even further down the line. Everybody struggles with managing equity. How much money do I bring in? Where do I manage that? What's the transparency to the investors? At Revere Partners, we work with companies that are raising 50,000 all the way up to 300 million in equity. And for me and the companies that I've started with and the companies that I advise with, I suggest they use a tool called Carta. And that's through, at one point managing it on spreadsheets, struggling with my board meetings. The Carta tool is the best out there for managing equity, managing transparency, managing your board meetings. And I have literally the expert at managing equity for your companies, Chris Hoffman, who came from Carta. And appreciate you spending some time with us, Chris, and talking about a founder's intro to equity. So why don't you give us your background and let's jump right in.
Yeah, thank you so much, Travis, for having me. It's so good to be here. And I can't wait to tell you more about the intro to equity. So I'm Chris Hoffman, as Travis mentioned. I worked at Carta for over 3 years, learning all about cap tables and equity. I didn't know that was a field I could go into before. And I jumped in and I just fell in love with it. And about 3.5 years into my tenure at Carta, I decided to go off my own and do equity administration for companies that are on Carta, and equity administration and consulting for other companies as well. So this is what I love, and I'm so excited to share it with you guys.
Yeah, I mean, it's just so nice to have a resource. Obviously, we've got the tool, but one thing that I found in working with Carta, they're great with the tool, but as far as the education and the how and the why, because when you're dealing with people's money, other people's money, you really want to make sure it's well managed and more than anything, giving them a place to be able to see, based on, there's a lot of complexity in that. So let's jump in.
Yeah, thank you so much. I also thought of something that I wanted to mention is it's funny. I talk to companies and they love the software solution, but they're still like, I don't want to manage it. And then I talk to lawyers on the other end, and lawyers say, we don't want to manage that either. So
Yeah,
it's good to have someone in the middle, and that's why I started this. So
yeah.
this is going to be a founder's intro to equity. This is specifically talking C corp style equity. So first, let's jump in. A cap table, which you may or may have not heard of, is a capitalization table, short for that. It tells what the ownership is in a company, who owns what, how much. So if you're a starting founder and you own all of your company, then you're the only person on your cap table and you have 100% ownership. Most companies, as Travis mentioned, we use a software. Carta, there's other ones like Pulley, LTSE Equity, Equivista to manage their cap table because it's a lot easier to update and see that data and see it in real time. Now, the first thing is when you first incorporate your company, you'll notice that you need to create something called authorized shares. This is the number of shares that you're able to issue to sell to investors, to issue to yourself, to employees. And this can increase in the future. That's known as the authorized shares. A common starting place for that when a company is first starting is 10 million. Now, you can do different numbers. You can do a million, you can do 100 million, but that's typically a very common number that I see in my practice.
Yeah.
So these are some common types of equity, and we'll go into each one of these in a little bit more detail. Preferred shares, common shares, restricted stock awards, also known as RSAs, options, restricted stock units, safes, convertible notes, warrants. So let's talk about some of those. First, I want to talk about preferred versus common shares. So preferred shares are the type of equity that are typically sold to investors when you're raising money for your company, fundraising round. These shares usually come with some type of rights and preferences, specifically liquidation preferences, that makes them more favorable for the investors. And they're often always a higher price than common shares. Investors pay a premium for these higher rights and preferences. The price per share for preferred shares, that's what determines your company valuation. So if you hear of somebody talking about a unicorn, that means the price per share times the total number of shares was equal to a billion or more. So that's how the company valuation works. It is different from
And
many.
valuation is a whole nother webinar, right? I mean, I talk to founders probably about 5 to 10 a day, and sometimes they give me the valuation of their company. And so let's do a follow up on how to value a company because
Perfect.
its own unique webinar, right?
Yeah, yeah, it really is. And then the different types of valuations too.
Yeah.
There's a lot that goes into it. Common shares. So this is the type of equity that you typically start out with when you first start your company. Founders shares, if you've heard of those, are a type of common shares. Options, if you've heard of those, and we'll talk more about these later too, those become common shares. So the price of a common share is determined by what's called a 401A valuation, which is provided by a third-party firm. So you pay a third-party firm to determine the value of your common stock. But the benefits of Carta and some other softwares are they have those 401A valuations yearly included in their subscription. And every time you raise money, because every time you raise money, you'll need to value it again. Some other equity definitions that we saw earlier. Restricted stock awards, they're a type of common stock that vests, and vesting we'll talk about as well. That just means it's earned over a certain period of time. Options are the right to purchase a set number of shares at a predetermined price determined by that 401A valuation. Options also vest. They're almost always vest. Restricted stock units are another type of award similar to options that vest over a period of time, but they must settle before the holder receives company shares. And that settlement is usually happens during an IPO or acquisition or some type of event like that. Yeah. Safes are simple agreements for future equity. So this is a type of note, a safe note, in which an investor gives money to your company in exchange for future shares. We'll talk about safe notes in a minute. They're very beneficial and honestly very common in these days with early stage companies. Convertible notes have a similar format, but they're a debt note, which can be either paid back or converted to equity in the future. They also carry an interest rate usually. Warrants are similar to options.
At the point where founders, especially tech founders, start to glaze over, right? That's why we need somebody like you. This is great.
Yeah. Yeah, you're exactly right. Warrants, similar to options, warrants that it's the right to purchase shares. Let's talk about safe notes because these are a very common one that we see, especially in these days. So one of the most common for founders to raise money in the early stages. And the reason for that is because they're pretty simple. It's the investor gives the company money in exchange for future shares, right? The reason for that is because when you're first starting out, it's kind of hard to determine a valuation. You can have an idea, start implementing it, and you're like, maybe my idea is worth $500,000 today. Well, you don't know. It's hard to determine that until you get some revenue or product market fit and the other things that come with it. So that's why safe notes are popular. You can give the investors shares later for the money they're giving you now. Yeah. So some key terms with safe notes are two things that are usually found on a safe note, but don't have to be. Discount rate. So one of the risks that investors doing is they're giving you money, oftentimes in the early stage when you don't have revenue or they don't know if it's going to work out, but they believe in you as a founder. So safes come with a discount rate, which the investors can get a discount on the price per share the next time you raise a round. There's also something called a valuation cap, which does a similar thing. It says if it's $2 million valuation cap on a safe note and you're raising it at a $4 million valuation at your next financing round, then they're going to get a discount on that because their cap is at $2 million. We can go into more terms. We could talk more about terms. This could also be another webinar by itself.
Yeah, exactly.
Just talking about notes. So again, they can include both of those, neither of them, either one, the most beneficial for the investor. The next thing is an equity incentive plan. And this is what a ton of, especially tech companies, create these days for their employees. So it's also known as an option pool or an option plan. It's a portion of those authorized shares that you started with that's set aside to give to any service providers like employees or advisors, consultants. Common starting point for an equity incentive plan is about 10 to 15% of your total company shares. We've seen it higher, we've seen it lower. It really depends on what you want and your strategy behind it. Equity awards like RSAs, options, and RSUs can come from the plan. Vesting is really important. So vesting refers to the way in which your shares or options are earned either over a period of time or through performance-based metrics. So the two types of vesting schedules or the two types of vesting are time-based vesting, where you earn them over a period of time, let's say 2 or 4 years, and then milestone or performance-based vesting, which is oftentimes for like a sales team. If they have to hit certain metrics, you hit those, you earn those shares. You don't hit them, you don't earn the shares.
And most of the time, Chris, I see people kind of vesting over 4 years. Is that typically kind of the benchmark?
That's exactly right. 4 years is the most common that you'll ever see. and it
Yeah.
and it can be monthly or quarterly like this on this next one. Very, very common. The most common I've ever seen is 148th monthly with a 1 year cliff. A cliff's a time period that you got to achieve before you vest any shares. And companies do that. I mean, it could be obvious, it could be not, but it's for loyalty, right? They want to see that you're there for a year. They want to see that you're there for 6 months and you're not just vesting a few months of shares, buying those shares, and then leaving.
Yeah.
So that's why they have the cliff. And then the rest. So in this example, 148th monthly with a 1 year cliff, 25% of the shares vest on the 1 year mark. And then the rest, those 75%, vest in equal monthly installments. The next common one that I see is 148th monthly with no cliff, which is just 148th of those shares will vest every month for 4 years. And then the third one is a quarterly, which is also very common in options and RSUs. So they just vest each quarter, and then you can have a cliff or you might not. But yeah, you're exactly right, Travis. 4 years is the most common.
Yeah.
So types of options. So this is important once you start your equity incentive plan or your option pool. You have incentive stock options, which these can provide beneficial tax treatment for U.S. employees as long as you follow the rules. The important part is the holder has to follow the rules and the company has to follow the rules. And we could dive in deep at another webinar, or we can, ask me questions about this later too, to dive into all the requirements. But there are a couple that I wanted to note. They're not usually taxed when exercised. When you purchase the shares from those options, ISOs are not usually taxed. Employees also, to gain the most beneficial tax treatment, the main rule is that you have to hold your shares at least 2 years from when you receive them and at least 1 year from when you actually bought those shares, exercise them, to have the best tax treatment and to get long-term capital gains rate on those. There's some other rules that apply. Not going to jump into those right now, though.
Yeah.
The next one is non-qualified stock options, so NSOs. So NSOs can be issued to employees, but they also can be issued to other service providers. They're not as beneficial tax-wise for the holder because when you exercise an NSO, and it becomes when you're purchasing those shares, you typically have to pay tax if the value of those shares has gone up from the time that you got them. And that's what the tax is based on. It's based on the spread between what you pay for them and what they're worth in that moment when you exercise and purchase those shares. So exercising options, I've mentioned this word a couple of times already, but essentially it's the right, you're exercising your right to purchase shares in the company. So when you receive an option, you're not getting any shares yet. You're earning the right to buy those shares. Once you buy them, once you exercise your options, then you become an actual owner in the company. So I put a little example here. You get 12,000 options at $1 per share. It vests monthly over 4 years. No cliff in this example. So you're going to get 250 shares per month. And each time you vest, those become eligible to exercise or purchase. So every month you could essentially purchase and exercise 250 shares for $250. Now, tax may or may not apply depending on what kind they are and what the value of the shares is at the time. I did want to mention this, Travis, that remember that exercising is a very personal choice. It just depends on the person. If you believe the company has this amazing trajectory and the value is going to go up like crazy, it's going to be amazing, you're going to want to exercise, but it's so personal. You have to decide for yourself if you want to purchase those shares. Because if the time comes when the company doesn't, then that might not be the best decision to exercise. So it's a very personal choice. Okay, the next thing is called a post-termination exercise period, or a PTEP. So the PTEP is a period in time after the employee or holder leaves the company, whatever form they leave, in which they can purchase their shares. These are some very common post-termination exercise periods. When you leave voluntarily or involuntarily, you're let go. 90 days. With cause, you did something really bad, you got no days to exercise. Retirement, disability, death, you usually have about 12 months. These, I did want to mention some companies, and if you want to create a certain type of culture in your company, oftentimes companies will extend that to be a lot more than the standard 90 days, 1, 2, 3, 7, even more years after that. And that allows the employees or the option holders to just have more time to earn that cash or get the cash in order to exercise. Depending on their exercise price, it could be a lot, depending on how many they received. Okay, I want to finish by giving you some pro tips from a founder's standpoint. The other stuff was more basic stuff, and this I want to give you some practical things that you can use when you're creating your equity structure. So, number one, get your cap table accurate from inception. Get it right away. For me, for example, I'm 100% owner in my company currently, and so I have a cap table on Carta that's just me. And I say, do it right from the start. You'll save hundreds or thousands of hours and dollars. And I've seen this firsthand. I've had to work with companies who have hired me to fix their cap tables way later on. Number two, if you plan to raise money from outside investors, I recommend always having vesting schedules on all your stock and options. Even if you're the founder, give yourself a vesting schedule, whether that be 2, 3, 4 years. It shows the investors that you're dedicated and you're in it for the long haul. There's a term called known as dead equity, which investors don't love because it means that somebody who has a lot of equity could just walk away and they would still own a lot of the company, even though they wouldn't be working for the company. So investors like to see that there's vesting schedules, that you have to earn it over time. Stay committed. Number three, when incorporating, there's something called founders preferred stock. That is it's a special form of stock. It's common stock, but it allows founders to later on sell their shares to get some liquidity for themselves, to sell it to outside investors. And those investors, instead of buying the common stock, it gets converted into preferred stock for them, which has a lot of cool benefits. So I consider doing that. The one rule is investors don't like to see more than about 15 to 20% of your total holdings as this founder's preferred stock, or else they think you might just sell out in the future. Okay, next, if you have an RSA, restricted stock award, consider filing an 83B form with the IRS within 30 days of issue date. This is important because RSAs vest over time. If you file the 83B within 30 days of issue, you're going to recognize the income from that on the date of issuance, as opposed to as they vest. And so if you've got a 4-year vesting and the company value goes up significantly over time, you could owe a lot of taxes if you don't decide to recognize that income upfront. So that's something that's important. All these things, please check with a tax attorney, tax accountant, your CPA. Make sure that you're doing it right for your personal situation. Next thing is use a software that has capabilities to manage and scale with your business as your cap table grows, because it's going to get complex as you grow. I work with some companies that are just very complex because they're very large. They have lots of employees. So make sure that you're picking something that helps you scale. Also consider allowing options to be early exercisable, similar to an RSA, and being able to recognize that income on issue date, so you don't have to owe massive taxes later, potentially. If employees are allowed to early exercise their options, they can also file an 83B form within 30 days of that exercise. That could potentially save them for future taxes. If the company value goes up and up and up, they can recognize, again, that income, their option income, on the day that they exercise, as opposed to in the future when they vest. Last couple of things are, when you're planning to develop an equity incentive plan, think about your purpose for creating it. A lot of people just go into it and think, I just want to give them, I just want to give my employees options. Well, think about your purpose. Are you trying to maximize your employees' tax benefits and give them awesome, bonuses to what they're getting right now? Are you trying to add additional write-offs for the company and tax benefits for your company? Are there a mix of reasons? So think about the purpose in creating that when you're creating it. And always, I'm happy to help with any of those questions as well. And remember, last thing is, remember that dilution is okay. If you're raising outside funding and your value is going up, the value of your company is going up over time, you're going to get diluted. And that's okay, because your holdings are still becoming more valued as you get diluted, right? There's a fine line, and there's a balance between too much dilution and not enough. But just remember that it's okay, and that, that being generous is okay.
Yeah. So, Chris, a couple things that kind of come to mind because as
Yeah.
I've raised money for various businesses, I've had people come in and talk about non-dilution. They want to have a non-dilution clause in the money that they're putting in. They wanted to buy 10% of the company and they want to have a non-dilution clause, which actually caused a couple times for me to walk away from certain investors that I said, well, the goal here is to grow the company together. That's why
Yeah.
I'm bringing in this strategic money often. Talk about non-dilution and, do you see that much? Do you shy away from that? What do you suggest for founders when people come to them with that term?
Yeah, that's a great question, Travis. I'm of the suggestion of what you did. I try to stay away from those because it really can, if you're willing to risk um, diluting yourself, you want partners that also have that mentality. And again, dilution's okay, whether that's from a founder's perspective or an investor's perspective. If you're growing a company together and you're bringing on even more strategic people in the future, that's a great thing. Everybody's going to win. By doing that, I feel like I know they have their reasons for it, but I feel like it is a little bit selfish to put one of those clauses in and say that, hey, I need to stick with this, certain percentage.
No, I agree. Yep, that was the end result.
Yeah.
And then, I often see in investor presentations, people talk about, interest and discounts and warrants, so, like one of our products, One Click Referral, we were raising 1.75 on it in three different tranches, right? Talk about tranches and interest, discount, warrants, that concept for a second.
Yeah. So was it a promise to
It was
invest
through a
in three
convertible
different
note.
tranches?
Yeah.
Okay.
And that interest associated with it.
Yeah. Yeah. Convertible notes they're a very popular way to raise money, especially with things called bridge rounds, which is something I mentioned here. When you need a little bit of cash, but again, you're not ready to give those shares yet,
Yeah.
and you want them to convert later, kind of like we were talking about with a safe note. They will come with interest, and interest rates that I see are usually around anywhere from like 6 to 8%. I know they can be higher, they can be lower, but that's usually how it works out. And essentially, what happens is you have the principal amount that they invested, and that's the convertible note. And then the interest that gets added on that, whether it's a daily interest or an annual interest, it will get added on the end. And when it converts to shares, they'll get their principal amount plus whatever the interest amount was, divided by the number of shares. And then sometimes there's also a discount rate on top of that. So it's a good, people like it because it's, again, you get the cash right now. You can kind of worry about the shares later, but it is something to be aware of is that interest rate. How much will you be giving up in the future?
Yeah.
It's the same thing with warrants. So with warrants, they're like options, except they're more for investors. The investor is investing, in your financing round right now, let's say, and you give them, they want to buy more at that same price later. So you give them a warrant and they can purchase more of those same round of shares, more of those same shares later by exercising the warrant and paying for that.
Yeah.
It's a way to, it will dilute a little bit more in the future when they exercise that, but it's a way to give them some extra benefits, you could say, to those investors to say, oh yeah, you want to invest another, 100,000 into the company. Sounds good. Here's the option to do that in the future.
Yeah.
Have you noticed anything that might not be the best, like when you've given warrants or convertible notes?
No, I think it's fair. It's
Yeah.
sort of interest on their money a little bit, right? And the justification there is, you put money in the stock market, it's at a certain interest rate. I think
Yeah.
especially as we get early investors specifically, I'm always, and like I said, with all the startups I'm talking about, the first question I ask is how much money have you put in?
Yeah.
Because I'll be honest, if somebody hasn't put their own personal money in, they don't believe in themselves. It's very hard for me to try and gather other funding sources for them.
Yeah.
next phase to me is always the angel investors, friends and family, because there's times where me as a entrepreneur, up at 3 o'clock at night, for a week straight, running my products and my business and my team, where I've thought, okay, if this was just my money that I had put in this, and if it was a small enough amount, I would probably have given up by now. But
Yeah.
running a company, building a product, being successful, you see all the people that are successful. There's a lot of movement towards that, but this is a marathon, not a sprint, right? And I always say it's really a marathon at a sprint's pace if you're running your company at the rate that many people are and need to. So bringing in your own money, bringing in angel investment, and then obviously going out and bringing in venture capital, private equity, everything that comes after that. But I always look to the companies that we're interested in. And first question is, how much have you raised? How much have you put in yourself personally? How much have you brought in friends and family? What strategic investors have you brought in, which is also very important before you start talking to outside investors. Well, Chris, appreciate your time. This was very valuable, and I know people are going to have a lot more questions. How does everybody get in touch with you? Oh, there we go. All right.
Yeah, thank you. We were right on cue. Thank you so much for having me, Travis. I really
Almost
appreciate
like I've done this before.
Yeah, right.
Yeah.
So you can find me on LinkedIn. I'm active on LinkedIn. Equity admin. I took the easiest name so that everybody know exactly what I did. Equity administration.
Well,
Website
Chris,
equityaadmin.co, and then
appreciate this. Appreciate all the help that you provided us, and you've been a great resource. And I'm sure you'll have people reaching out who have questions about this. So thank you for your time.
Yeah, thank you so much, Travis. And yeah, let me know if you have any questions. Thanks, everybody.